Before 1st of March 2020, South African citizens who worked in other countries for less than SARS's 183 days in a year rule have declared their offshore income and any taxes deducted offshore on their South African ITR 12 tax return. The new 1.25 million exemption does not apply to these South African taxpayers who worked offshore for less than the 183-day period rule. The 1.25 million exemption on income earned offshore only applies to South African citizens who worked offshore and earned remuneration offshore for at least 183 days in the year, of which at least 60 days were continuous. These South African citizens have up to now been considered by SARS as non-residents for tax purposes, and these citizens have been seen as being liable for tax in the country where they worked. In cases where these South African citizens worked in a country where there is no income tax, then these South African citizens have benefited by paying no tax in the foreign country where they worked and paying no tax in South Africa. SARS now sees this as unfair. SARS has introduced new tax measures targeting those South African citizens who worked in other countries for at least the 183-day period. These citizens will now pay tax in South Africa on the remuneration earned offshore less an exemption amount of up to 1.25 million rand. These taxpayers must also register with SARS as provisional taxpayers. 1.25 million sounds very generous, but remuneration earned offshore must include salary and fringe benefits such as flights, transport, accommodation, security services provided, etc. So the 1.25 million could be used up very quickly. WinTax caters for these new regulations in a very simple way with a minimum of entries. Whether the taxpayer earned the remuneration working offshore for more than the 183-day rule period or less than that period, any income tax deducted in the foreign country can be claimed on the South African citizen's tax return and in WinTax under code 4111. WinTax will calculate any 6-quat limit, if applicable, on how much of the tax deducted offshore may be claimed as a tax credit on the tax assessment. Obviously, the exit and entry stamps in the taxpayer's passport would be used to verify the date spent in the foreign country. Note that SARS says that the exemption applies where at least 183 days are spent actually working in the foreign country earning the remuneration. If a taxpayer spends 160 days actually working in a foreign country and then spends 30 days on holiday in that foreign country, then, although their passports may show they spent 190 days in the foreign country, they never spent 183 days actually working in the foreign country earning the foreign remuneration. In a case like that, the exemption will not be allowed.